Before we begin, it's critical to understand that the information provided in this video is for educational and informational purposes only. I am not a financial advisor, attorney, or certified housing counselor. This presentation is not intended as a substitute for professional financial or legal advice. Every individual's financial situation is unique, and the options discussed may not be suitable for your specific circumstances. You should always consult with a qualified professional, such as a HUD-approved housing counselor, a financial advisor, or an attorney, before making any decisions regarding your mortgage or financial situation. The letter arrives in a plain white envelope, but you know what it is. Your stomach clenches before you even open it. The paper feels heavy in your hands, and as your eyes scan the page, the words blur together, but a few jump out in stark, terrifying clarity. Past due, default, foreclosure. In that moment, the world shrinks. The home you've built, the walls that hold your memories, the single biggest investment of your life. It all feels like it's about to be swept away. You feel powerless. You feel isolated. You might even feel ashamed. You think, this is it. It's over. But what if I told you that in most cases, that letter is not the end? What if I told you it's the beginning of a negotiation? And what if I told you something that might sound completely insane right now? Your bank, the very institution sending you this terrifying letter, does not want to foreclose on your home. Let me say that again because it is the single most important mindset shift you need to make right now. Your lender does not want your house. Foreclosure is a nightmare for them. It's an incredibly expensive, time-consuming, and bureaucratic process that often results in them losing a massive amount of money. They have to hire lawyers, go to court, maintain the property, and then try to sell it in a market they can't control. It is their absolute last resort. What they really want is a reliable stream of payments, and if you can no longer make your original payment, they are often surprisingly willing to change the rules of the game to create a new payment you can actually afford. This hidden escape hatch, this negotiation process, is called a mortgage modification. And understanding how it works is the key that can unlock the door to saving your home. You are not alone in this. Far from it. Right now, hundreds of thousands of American families are in the exact same position, staring at that same letter, feeling that same dread. They've been hit by a job loss, a medical crisis, a divorce, or the crushing weight of inflation that has made their budget simply impossible. The purpose of this video and this entire series is to pull back the curtain on the confusing and intimidating world of mortgage modification. We are going to demystify the process step by step. We will arm you with the knowledge, the language, and the strategy you need to stop feeling like a victim and start acting like an informed homeowner defending your most valuable asset. We're going to turn that fear and uncertainty into a clear, actionable plan. So, what exactly is a mortgage modification? Let's get a simple, clear definition. It is a permanent change to one or more of the original terms of your mortgage loan. Think of it like financial surgery for your mortgage. The bank, your lender, agrees to alter the contract to make your monthly payments more manageable. This isn't a short-term fix like a forbearance, which just pauses your payments. A modification is a long-term solution. How do they do this? They have a few tools in their toolbox. They might be able to lower your interest rate, sometimes dramatically. They could extend the term of your loan, say from 30 years to 40 years, which spreads the remaining balance over a longer period and reduces each individual payment. Or, in some cases, they might even agree to forbear or forgive a portion of the principal balance, the total amount you owe. The goal of all of these strategies is the same: to get your monthly payment down to a number that you can sustainably afford based on your current financial reality. Now you might be thinking, this sounds too good to be true. Or why would a bank ever agree to this? They're losing money. Remember what we said earlier. Foreclosure is a massive loss for them. A modified loan, even one where they make less profit than the original, is almost always a better financial outcome for the bank than a foreclosure. A performing loan, even at a lower rate, is an asset on their books. A foreclosed property is a liability. They are making a calculated business decision, not doing you a personal favor. Understanding this dynamic is crucial, because it puts you in a much stronger position when you approach them. But before we go any further, we need to shatter two of the biggest and most dangerous myths that stop people from even trying to get a modification. The first myth is, it's too late. I've already missed payments, so my credit is shot and the bank won't listen to me. This is completely 100% false. In fact, the opposite is true. Mortgage modifications are specifically designed for homeowners who have experienced a financial hardship and are already delinquent, or are in imminent danger of becoming delinquent. Proving you have a legitimate hardship is actually a core requirement of the application process. So if you've missed payments, you are not disqualified. You are precisely the candidate these programs were created to help. The key is to act now, not to wait until you are months and months behind and the legal process has gone too far. The sooner you start the conversation, the more options you will have. The second and perhaps more critical myth to bust is the idea that all mortgage help is a scam. Let's be brutally honest. There are predators out there. You've probably seen the signs on telephone poles or gotten sketchy emails. We guarantee we can stop your foreclosure. Pay us a fee of thousands of dollars, and we'll handle the bank for you. Run. Run as fast as you can. You should almost never have to pay a third-party company for help with a loan modification. The process is designed to be done directly between you and your lender, or with the help of a free government-approved resource. These free resources are HUD-approved housing counseling agencies. They are legitimate, they are experts, and their services are paid for by the government and nonprofits, not by you. Anyone demanding a large upfront fee is almost certainly a scam artist preying on your fear. A legitimate mortgage modification is a formal process with your existing lender, not a shady backroom deal. So where do we go from here? Over the course of this series, we are going to build your roadmap. We'll break down the different types of modifications available, from in-house bank programs to government-backed options. We will walk you through creating the single most important part of your application, the hardship letter. This is where you tell your story, and we'll show you how to do it in a way that is compelling and effective. We will give you a detailed checklist of every single financial document you'll need to gather so you are fully prepared. We'll even cover what to do if your application is denied, because a no is not always the final answer. The journey to save your home starts right now with this first step, shifting your mindset from fear to empowerment. You are not at the mercy of your bank. You are a potential partner in finding a solution that works for both of you. You have options. The letter in your hand is not an eviction notice. It is an invitation to negotiate. And the first step in any successful negotiation is knowing the rules of the game better than your opponent. Let's learn the rules. The first rule is this: you are not fighting the bank. That's a myth. The monolithic, faceless building downtown isn't who you're dealing with. You're dealing with a system, a complex machine with different parts, and if you don't know what each part does, you're flying blind. So let's turn on the lights. First, there's your servicer. This is the company you send your check to every month. It's who you call when you have a question. They might have a big, familiar bank name, or they might be a company you've never heard of. But here's the secret. In most cases, the servicer does not actually own your loan. They are a hired contractor. Their job is to collect payments, manage your escrow for taxes and insurance, and this is the critical part for you right now: manage the process when homeowners fall behind. They are the gatekeepers. They are the ones who will process your application for help, but they don't make the final decision. That power belongs to the second player, the investor. The investor is the true owner of your mortgage note. This could be a government-sponsored entity like Fannie Mae or Freddie Mac, which own or guarantee a huge percentage of mortgages in America. It could be a government agency if you have an FHA or VA loan. Or it could be a private collection of investors like a pension fund or a Wall Street trust. This is the most important distinction you need to understand. The servicer is following a rulebook written by the investor. When you ask for help, the servicer's job is to see which chapter of that rulebook your situation fits into. They have very little wiggle room. This is why yelling at the customer service representative on the phone is pointless. They are not the ones saying yes or no. They are simply checking boxes on a form dictated by someone else, the investor. Your job isn't to convince the person on the phone. Your job is to give them the exact information they need to check the approved box according to their investor's guidelines. So why would this invisible, all-powerful investor ever agree to help you? Why would they agree to change the terms of a contract and accept less money than you originally promised to pay? It's not out of the goodness of their hearts. It is pure, cold, calculated business. The alternative to helping you is foreclosing on you. And foreclosure is a disaster for lenders. It's expensive, it's time-consuming, and it's risky. They have to hire lawyers, which cost thousands. They have to go through a legal process that can take months, or even years, during which they aren't receiving a single payment from you. Once they finally take possession of the house, they have to secure it, maintain it, pay the property taxes and insurance on it, and then try to sell it on the open market. A vacant, foreclosed home often sells for far less than what a normal occupied home would. By the time the dust settles, a lender can easily lose 20, 30, even 40% of the loan's value in a foreclosure. You, on the other hand, are offering them a better deal. You're saying, look, I can't pay the full amount right now, but I can pay a reduced, consistent amount. If you work with me, you can turn this non-performing asset back into a performing asset. You can keep a steady stream of income flowing, avoid all those legal and maintenance costs, and ultimately lose far less money. You are not begging for a handout. You are proposing a business solution that is in the lender's best financial interest. When you shift your mindset from a desperate homeowner to a strategic business partner, the entire dynamic changes. You are holding a valuable card, the ability to save them from their own worst-case scenario. This is where a mortgage modification comes in. A modification is not a refinance. A refinance is a brand new loan. You have to apply, qualify with your credit and income, get an appraisal and pay closing costs. A modification is different. It is a permanent change to the terms of the loan you already have. The goal is simple: to make your monthly payment affordable for the long term, based on your current financial hardship. So what can they actually change? There are three main levers the servicer can pull to restructure your loan. Think of it like a toolkit. They will almost always try to use them in a specific order, from the simplest tool to the most powerful. The first and most common lever is reducing your interest rate. For many people who got their mortgages when rates were higher, this can be a powerful fix. Let's imagine a family, the Jacksons. They have a $300,000 loan balance at a 6% interest rate. Their principal and interest payment is about $1,800 a month. But after a medical emergency, they can only afford about $1,500. The servicer, following the investor's rules, might be able to lower their rate to the current market rate, let's say 4%. That one change alone could drop their payment by over $350, bringing it down to around $1,430. Suddenly it's affordable again. The Jacksons can stay in their home, and the investor has a performing loan. Problem solved. But what if a rate reduction isn't enough? What if the Jacksons' income dropped so much that even at the lowest possible rate, they still can't afford the payment? That's when the servicer reaches for the second lever, extending the term of the loan. Your original loan was likely for 30 years or 360 payments. A modification can extend that repayment period to 40 years or 480 payments. By stretching the same loan balance over an additional 10 years, each individual payment becomes smaller. Now, the downside is that you will end up paying more in total interest over the life of the new longer loan. But the immediate, overriding goal of a modification is not to get you the best possible deal over 40 years. It is to save your home right now. It's financial triage. You're stopping the bleeding today so you have a future to worry about tomorrow. For the Jacksons, extending the term might shave another $100 off their monthly payment, getting them to a number that works. But for some people, even that isn't enough. The hardship has been too severe. A job loss, a disability, a divorce. This is when the servicer might be authorized to pull the third and most powerful lever, dealing with the principal balance itself. This usually happens in one of two ways. The first and more common way is called principal forbearance. This is a game changer. The lender takes a portion of your principal balance and sets it aside in a separate, non-interest-bearing account. You don't make payments on this forbearance amount. It just sits there silently. For the Jacksons, if they still owe $300,000, the lender might forbear or set aside $60,000 of it. Now, their monthly payment is calculated based on a balance of only $240,000. This dramatically reduces their payment. That $60,000 doesn't just disappear. It becomes a balloon payment that is typically due at the very end of the loan, when you sell the house, refinance, or make your final payment in 40 years. In essence, it's an interest-free loan from your lender that allows you to get your payments to an affordable level today. The second and much rarer way is principal forgiveness. This is the holy grail. It means the lender agrees to simply erase a portion of your debt. It's gone forever. This was a tool used more frequently in the wake of the 2008 housing crisis, especially through specific government programs. While it is not common today, it still exists within the guidelines for certain types of loans, particularly in situations where a homeowner is severely underwater, meaning they owe significantly more than the home is worth. You shouldn't expect it, but you should be aware that it's a tool in the ultimate toolbox. So, a rate reduction, a term extension, and a principal forbearance. These are the building blocks of a mortgage modification. The servicer will use them, often in combination, to try and construct a payment that you can afford. But here's the crucial part. This is not a random process. The servicer doesn't just guess which tool to use. They are legally and contractually required to follow a specific, step-by-step sequence of calculations and offers. This rigid, formal process is known in the industry as the loss mitigation waterfall. Understanding this waterfall is like having the bank's playbook in your hands. It tells you exactly what they are going to offer, in what order they are required to offer it, and how to prepare your application to get the best possible outcome. It is the secret map to navigating this entire process. And in the next part, we are going to lay out that map step by step. This map is known in the mortgage industry as the loss mitigation waterfall. And it's called a waterfall for a very specific reason. The options flow downwards one after another in a strict, legally mandated order. A mortgage servicer can't just jump to the bottom. They have to start at the top and work their way down, evaluating you for each option in sequence. Understanding this order is your single greatest advantage. It tells you what to expect, what to ask for, and when you're being offered a fair deal. So let's start at the very top of that waterfall. The first option a servicer must almost always consider is a repayment plan. This is the simplest solution, designed for a temporary problem. Let's say you lost your job but you just started a new one. You missed 3 payments but now you have income again. You don't need to permanently change your loan. You just need a way to catch up. A repayment plan does exactly that. Your servicer will take the total amount you're behind, say $6,000, and spread it over a set period, typically 3 to 6 months, sometimes longer. They add a piece of that past due amount to your regular mortgage payment each month until you're current. So if your mortgage is $2,000 and you're catching up on $6,000 over 6 months, you'd pay your regular $2,000 plus an extra $1,000 each month for 6 months. It's straightforward. It's for people whose hardship is over, and they can now afford more than their regular payment for a short time. If you fit this profile, this is the first thing they'll offer. But what if your hardship isn't over yet? Or what if you have your income back, but you can't afford that extra $1,000 a month? You cascade down to the next step in the waterfall, a forbearance plan. Many of us became familiar with this term during the pandemic. A forbearance is a temporary pause or reduction of your mortgage payments. The key word is temporary. This isn't a long-term solution. It's designed to give you breathing room, typically for a few months up to a year in some cases, while you get back on your feet. Maybe you're on a temporary disability leave, or you're a seasonal worker in your off-season. The servicer agrees to let you pay a smaller amount, or even nothing at all for a set period. But here's the critical part. That money doesn't just disappear. At the end of the forbearance period, you have to address the payments you missed. This is where people get into trouble. They think forbearance is free money. It's not. It's a pause button. When you hit play again, you'll need to work out how to repay those skipped payments, which often leads you right back to needing a repayment plan or, more likely, the next option down the waterfall. And this next option is the one we're all here for. This is the big one. This is the loan modification. A modification is different from the first 2 options because it is a permanent change to the terms of your original loan. The goal is simple: to make your monthly payment affordable for the long term. This isn't for a temporary blip. This is for a significant, long-lasting change in your financial circumstances. And this is where the waterfall gets more complex, because a modification isn't just one thing. It's a toolkit. The servicer has several tools they can use, and again they have to use them in a specific order to try and get your payment down to an affordable level, which is usually targeted at around 31% of your gross monthly income. The first tool they pull out of the modification toolkit is capitalization. This is the most basic part of any modification. It means they take everything you owe, missed payments, accrued interest, and any corporate advances like foreclosure fees or force-placed insurance, and they roll it all into your unpaid principal balance. Your loan balance actually goes up. Now that sounds scary, but it's the necessary first step to a. Stop a foreclosure and b. Re-amortize your loan. By adding that past due amount to the balance, and then recalculating your payments over the remaining life of the loan, it brings you current instantly. For some people, if their hardship was temporary and their income is stable, simply capitalizing the arrears and recalculating the payment is enough. But for most it's not. The new payment is often still too high. So if capitalization alone doesn't work, the servicer moves to the next tool: an interest rate reduction. This is one of the most powerful ways to lower a payment. They can reduce your interest rate to the current market rate, or sometimes, depending on the program, even lower. Dropping your rate by even 1 or 2 percentage points can shave hundreds of dollars off your monthly payment. This is often the key that unlocks affordability. However, it's not a magic wand. If you already have a super low interest rate, say from 2021, there's not much room for them to lower it. And they will never lower it to zero. They are a business after all. They use a formula to find the lowest possible rate that gets your payment to that target affordability number. Let's say they've capitalized your arrears and lowered your interest rate as much as their guidelines allow, but the payment is still not affordable. What's next? They cascade down to the third tool, a term extension. Most mortgages are for 30 years or 360 payments. With a term extension, they can stretch the life of the loan out to 40 years or 480 payments. Think about it like this. If you have a $30,000 car loan, your payment will be much lower if you pay it over 72 months instead of 48 months. The same principle applies here. By spreading the new, higher balance over a longer period, each individual payment becomes smaller. The major downside, of course, is that you'll be paying for a longer time and will ultimately pay significantly more in total interest over the life of the loan. But the immediate goal of a modification isn't to save you money in the long run. It's to save your home right now. So, they've capitalized, they've lowered the rate, and they've extended the term to 40 years. But for some homeowners, particularly those in high cost of living areas or those who have suffered a massive income drop, even all of that combined isn't enough. The payment is still too high. This is when they reach for one of the most powerful and misunderstood tools in the box. Principal deferral, also known as principal forbearance. This is a game changer. With the deferral, the servicer takes a portion of your principal balance and sets it aside. They essentially create a second silent lien on your property. This amount requires no monthly payments and accrues zero interest. It just sits there parked in the background. You only have to pay it back when the loan ends, either when you sell the house, refinance, or reach the end of your new 40-year term. By deferring a chunk of the principal, the part of the loan you do have to make monthly payments on becomes much smaller, which drastically reduces your monthly payment. This is how you hear stories of people getting their payments cut by a third or even in half. It's not forgiveness. It's just kicking a piece of the can way down the road. Now, you might be wondering about the ultimate tool, principal forgiveness. This is the unicorn of mortgage modifications. It's when the lender agrees to simply erase a portion of your debt forever. Let's be crystal clear. This is exceedingly rare for most loan types. Lenders are not in the business of giving away money. However, it does exist in some very specific, often older government-backed modification programs, or in unique situations where a home is so severely underwater that the lender calculates they will lose less money by forgiving some principal than they would by foreclosing. You should never go into this process expecting principal forgiveness. Think of it as a lottery ticket. It's a possibility, but a remote one. Focus on the other tools: capitalization, rate reduction, term extension, and deferral. That is the standard recipe for a successful modification today. The servicer runs a complex calculation, a mini waterfall within the modification itself, applying these tools in order until they hit that magic number, that affordable monthly payment. But what if they use every single one of these tools, and they still can't get your payment to an affordable level based on your documented income? This is when you fall off the modification waterfall and into the final, last resort options. These are what are known as liquidation options, because they result in you giving up the home. These are the short sale and the deed in lieu of foreclosure. These are not modification options. They are alternatives to foreclosure. So that is the map. That is the waterfall. From a simple repayment plan all the way down to a full-blown modification with principal deferral. Now you know the sequence. You know the tools they have at their disposal. You are no longer navigating in the dark. But knowing the map is only half the battle. The other half is preparing for the journey. Your application is your vessel. It must be airtight, organized, and compelling. You need to present your financial situation in a way that fits perfectly into the boxes the servicer needs to check. And how you fill out that paperwork, the documents you provide, and the story you tell can make all the difference between getting the best possible modification and getting denied. And that is exactly what we're going to break down next. How to build a bulletproof application package that forces your lender to say yes. Your application package isn't just a stack of papers. It's a meticulously crafted argument. It's the legal brief for the most important case of your life. The case for keeping your home. Every single page, every number, every sentence has a job to do. And that job is to lead the person on the other end, the underwriter, the loss mitigation specialist, to one and only one logical conclusion: that you are a responsible homeowner who has fallen on temporary legitimate hardship, and that granting you this modification is not only the right thing to do, but it's also in the bank's best financial interest. Let's start with the heart of your entire application, the hardship letter. This is your opening statement to the jury. So many people get this wrong. They either write a single vague sentence like, "I lost my job and can't pay," or they write a 10-page emotional saga that the underwriter simply doesn't have time to read. The truth is, a powerful hardship letter is a masterpiece of precision and sincerity. It should be 1 page, max. It needs to accomplish 4 specific things. First, clearly state the nature of your hardship. What happened? Be specific. Don't say medical issues. Say, "I underwent an emergency appendectomy on May 15th, which resulted in 2 months of unpaid medical leave from my job." Don't say reduced income. Say, "The factory where I have worked for 12 years reduced all employee hours by 40% starting in January, directly cutting my take-home pay from $4,000 a month to just $2,400. See the difference? Specificity is credibility. Second, explain when the hardship began and why it was beyond your control. This is critical. Lenders want to help people who were hit by a curveball, not people who made irresponsible choices. A sudden illness, a layoff due to downsizing, a divorce, the death of a spouse who contributed to the income, these are the classic understandable hardships. You need to connect the dots for them. This reduction in hours was a company-wide mandate and was not related to my performance in any way. Third, you must explain what you have done to try and fix the situation yourself. This shows the lender that you are proactive and not just waiting for a handout. Since the layoff, I have been actively searching for new employment, submitting over 30 job applications, and have already had 2 interviews. I have also cut all non-essential family expenses, including cable television, streaming services, and dining out, to conserve our remaining funds. This paints you as a responsible partner in solving this problem. And finally, number 4, clearly state your goal. You need to tell them what you want. We are deeply committed to our home and our community, and we are respectfully requesting a mortgage modification that will create a more affordable monthly payment, allowing us to successfully resume our obligations and remain in our home long term. Your letter should be factual, concise, and honest. It's not a place for anger or blame. It's a business document with a human story. Write it, read it aloud, and ask yourself, does this sound like a responsible person I would want to help? Now, once you've written the story, you need to prove it with numbers. This is where the request for mortgage assistance, or RMA, comes in. This is the big scary form that asks for every detail of your financial life. Think of the hardship letter as the movie trailer and the RMA as the full-length documentary, full of facts and figures. Every single blank on this form must be filled in. Leaving something blank is a rookie mistake that can get your application immediately rejected for being incomplete. If a section doesn't apply to you, write "not applicable" or a 0. Don't just skip it. The most important sections are your income, your expenses, and your assets. You must be brutally honest here. The underwriter is a financial detective. They will cross-reference everything. If you claim you make $3,000 a month, but your bank statements only show $2,500 in deposits, that's a massive red flag. If you claim your grocery bill is only $100 a month for a family of 4, they will know you're not being realistic. Your goal on the RMA is to present a clear, mathematical picture of your hardship. It should show that your previous income was sufficient to cover the mortgage and your living expenses. Then it should show your current reduced income and how there is now a shortfall. The math has to make sense. Your total monthly income minus your total monthly expenses results in a number. If that number is positive, meaning you have extra money left over, they'll wonder why you need help. If that number is negative, it clearly demonstrates your need for a modification. This is your financial snapshot, and it must perfectly align with the story you told in your hardship letter. Next up is the evidence locker, your supporting documentation. This is where you back up every claim you've made. Every number you wrote down on the RMA needs a corresponding piece of paper. This is not the time to be disorganized. You need to be methodical. They will ask for recent pay stubs. Why? To verify your current income. If you're unemployed, they'll want your unemployment benefit statements. They'll ask for the last 2 years of your tax returns and your W-2s. Why? To establish your historical earning ability and to see what your income was before the hardship. This helps them believe that your hardship is temporary and you can recover. And then there are the bank statements, usually the most recent 2 or 3 months for all of your accounts. This is the document that trips up more people than any other. The lender is using them to verify everything. They're checking your payroll deposits. They're looking at your spending habits. And they are hunting for red flags. What's a red flag on a bank statement? A large unexplained cash deposit. If you suddenly have a $5,000 cash deposit, they're going to assume you have undisclosed income. If you borrowed that money from a family member to cover bills, you need to provide a gift letter explaining exactly that. Another red flag is large, unusual withdrawals or payments. If you're paying a $500 a month car payment for a luxury car that you didn't list as an expense, they'll find it. If there are regular payments to a storage unit, they'll want to know what assets you have in storage. Consistency is key. The story your bank statements tell must match the story your RMA tells, which must match the story your hardship letter tells. It all has to be one cohesive narrative. Depending on your specific hardship, you'll need additional proof. If it's a medical hardship, you'll need medical bills or a letter from your doctor, not detailing your condition, but explaining your inability to work. If it's a divorce, you'll need the divorce decree or separation agreement. If you lost your job, you'll need the termination letter. Each piece of evidence strengthens your case. Before you send anything, make a complete copy of the entire package for your own records. The whole thing. Every single page. Do not send your original documents. Send copies. And when you send it, use a method that gives you proof of delivery, like certified mail or your lender's secure online portal. Get a receipt. This is your proof that you met their deadlines. Because once you send that package, the clock starts ticking. But your job isn't over. In fact, in many ways, it's just beginning. You've presented your case to the court. You've told your story and provided the evidence. But now you're entering the most frustrating and nerve-wracking phase of this entire process. The waiting game. And this is a game filled with its own rules, its own traps, and its own strategies. What you do in the next 30 to 90 days, how you communicate with your lender, and how you respond to their requests can be the difference between a successful modification and a foreclosure notice. You've submitted the application. Now you have to manage the process. And that process is a minefield we're going to walk through together. The moment you hit send on that application, a clock starts ticking. But it's not your clock. It's the bank's clock, and you have no idea what time it's set to. This period of waiting is one of the most psychologically brutal parts of the entire process. You've poured your heart out, exposed your financial vulnerabilities, and now silence. This is the first major test in the minefield. The test of your own patience and nerve. Your first objective is to establish a clear line of communication. Under federal law, within 5 days of receiving your application, your servicer is supposed to send you a written acknowledgement. This letter is more than just a receipt. It's your first piece of official evidence. It should tell you whether your application is complete, or if they believe documents are missing. Critically, it should also provide you with the name and contact information for your single point of contact, or SPOC. Let's talk about the SPOC. This person, in theory, is your guide through this maze. They are your dedicated representative at the mortgage company, assigned to help you with your modification. In reality, the quality and helpfulness of SPOCs can vary wildly. Some are fantastic, knowledgeable, and genuinely want to help. Others are overworked, undertrained, and act more like gatekeepers than guides. You must learn to manage this relationship regardless of which type you get. Treat every interaction with your SPOC with professional courtesy, but never forget who they work for. They are not your friend. They are not your advocate. They are an employee of the institution that you are in a financial conflict with. Your goal is to make their job as easy as possible. Be organized. Be polite. Be persistent. When you call or email, have your loan number ready. Have a list of your questions written down. At the end of every single conversation, summarize what was discussed and what the next steps are. Then, follow up that phone call with an email confirming that exact summary. Hi Jane, just to confirm our conversation a few minutes ago, you've received my updated pay stubs, and you will confirm their receipt with underwriting. You expect to have an update from me by next Tuesday. Please let me know if my understanding is incorrect. This creates a paper trail. It's not about being confrontational. It's about creating a factual record of your diligence. This record is your armor, because you are about to enter the most frustrating, soul-crushing phase of this journey, the lost document limbo. This is a tripwire that snares thousands of homeowners. You spend hours gathering every document. You fax it, you upload it to their secure portal, you even send it certified mail. You wait a week, you call your SPOC, and you hear the words that make your blood run cold. I'm sorry, we don't show that we've received anything. Feels like a punch to the gut. Your first instinct is to get angry, to yell about how you sent it, to accuse them of losing it. Do not do this. It will get you nowhere. Take a breath. Remember your armor. That's very strange, Jane, because according to my records, I uploaded the full package to the portal on May 15th at 2:35 p.m., and I have the confirmation screen printout. I also have a FedEx tracking number, 7815 whatever, showing it was delivered and signed for by a Mr. Smith at your document processing center on May 16th. Could you please double-check? You see the difference? You've shifted from an emotional plea to a factual inquiry. You're not accusing. You're providing evidence. This forces them to take you seriously. Often, the documents aren't truly lost. They're sitting in a different department's inbox, or they haven't been scanned into the main system yet. Your calm, evidence-based persistence is what gets them to do the internal legwork to find your file. Always assume you will have to send everything at least twice. Keep a digital folder on your computer with every single page you've sent, clearly labeled. Keep a physical copy in a binder. Be more organized than they are. A close cousin to the lost document limbo is the missing document merry-go-round. This is where they acknowledge they got your package, but claim one specific item is missing. We have everything, Mr. Johnson, but we're missing page 2 of your bank statement. So you send it. A week later you call back. Okay, we got that, but now it looks like we need an updated utility bill. You send that. A week later. You know what? The underwriter is now asking for a letter explaining this one deposit from 3 months ago. This merry-go-round can feel endless, and sometimes it's a deliberate stall tactic. But more often it's a symptom of a chaotic system. Your file might be reviewed by multiple people, each with a slightly different interpretation of the requirements. The key here is to control the flow of information. When they first tell you documents are missing, ask for a complete list. Thank you for letting me know. To ensure we get this done efficiently, could you please email me a complete list of every single outstanding item the underwriter needs right now? Getting that list in writing is a huge win. It prevents them from adding new items one at a time. When you send the requested documents, you send them with a cover letter that says, "Attached are the documents you requested in your email dated May 20th, which completes the list of outstanding items." You are, again, building your record. You're boxing them in with their own words. While you're navigating this, another, more dangerous clock is ticking. It's the stale document clock. Your financial documents like pay stubs and bank statements have a shelf life. Most lenders consider them stale or expired after 30 to 60 days. So, if that missing document merry-go-round drags on for 2 months, the bank will turn around and say, "Okay, we have everything now, except your first set of pay stubs are too old. We need you to send the most recent ones." And the process starts all over again. This is where people give up. Don't let it happen to you. You have to be proactive. If you see the process dragging into a new month, don't wait for them to ask. As soon as you get your new pay stubs, as soon as your new bank statement is available, send them to your SPOC with a note. "Hi Jane, proactively providing my most recent financial documents to keep my file current for the underwriter." You are staying ahead of the game. You are anticipating their needs and showing them you are a serious, organized, and responsible applicant. Now, while all of this is happening, the waiting, the phone calls, the document chase, there is a terrifying process that might be running on a parallel track. It's called dual tracking. Dual tracking is when the mortgage servicer is simultaneously considering your loan modification application, while also actively moving forward with the foreclosure process. Let me be crystal clear. Just because you have submitted a modification application does not automatically stop a foreclosure. You might be diligently sending in documents and talking to your SPOC, while in another department, a different team is scheduling a foreclosure sale date for your home. It is a cruel and confusing reality of the system. Now, there are some federal protections. The Consumer Financial Protection Bureau has rules in place. For instance, a servicer generally cannot start a foreclosure if you've already submitted a complete loss mitigation application. And they cannot schedule a foreclosure sale or hold one if your complete application is still under review. The key word there is complete. This is precisely why they play the missing document game. As long as they can claim your application is incomplete, certain foreclosure protections may not apply. This is why your meticulous record keeping is not just about being organized. It's about your legal standing. You need to know when your servicer considers your application complete. Ask your SPOC directly and get it in an email. Can you please confirm that as of today my application is considered complete and is now in full review with underwriting? That email is gold. It is a critical piece of evidence that can be used to stop a foreclosure sale. You need to be your own warrior in this fight. Armed with dates, names, and documentation, you've navigated the communication minefield, you've avoided the document traps, and you've put a spotlight on the scary reality of dual tracking. Your file, hopefully now complete and up to date, is finally where it needs to be, on an underwriter's desk. The real decision is about to be made, and what they are looking for, the numbers they are crunching, and the secret formulas they use, that's exactly what we're breaking down next. So let's pull back the curtain. The underwriter isn't some gatekeeper sitting on a throne, deciding your fate based on a whim. Think of them more like a highly trained technician following a very specific, very rigid schematic. Their job isn't to judge you. It's to see if your financial situation can be re-engineered to fit into a pre-approved, profitable model for the investor who owns your loan. And the primary tool they use to do this is something called the modification waterfall. Imagine a series of waterfalls, one after the other. The underwriter starts at the top with the simplest, least drastic solution. They apply it to your loan and then they run a test. Does this solve the problem? Does it make the payment affordable? If the answer is yes, they stop. The process is over. But if the answer is no, your loan file cascades down to the next level where a more significant change is applied. They keep going down this waterfall until they either find a solution that works or they run out of options. The very first step at the top of this waterfall is called capitalization. It's the simplest fix. All they do here is take all the money you're behind, the missed mortgage payments, the late fees, any escrow shortages, and they just roll it into your principal loan balance. So if you owed $300,000 and you were $15,000 behind, your new loan balance becomes $315,000. They then re-amortize or recalculate your payment based on this new higher balance over your remaining term. For someone who had a very temporary hardship, maybe a short-term job loss, and is now making great money again, this might be enough. The monthly payment will go up slightly, but they're caught up and no longer facing foreclosure. But for most people in significant hardship, this doesn't solve the core problem. The payment is still too high. The test fails. So your file flows down to the next level. This next step is interest rate reduction. Here, the underwriter starts to lower your interest rate to bring the monthly payment down. Now there are rules. They can't just drop it to zero. Every loan program, whether it's FHA, VA, or a conventional loan held by Fannie Mae or Freddie Mac, has a floor, a lowest possible rate they can offer. This rate is usually tied to the current market rates, so they'll drop your rate step by step until they hit that floor. After each reduction, they run the test again. Is the payment affordable now? For many homeowners, this is the magic bullet. A significant rate reduction can slash hundreds of dollars off a monthly payment, making it manageable again. But what if you were already at a low rate? Or what if even dropping it to the floor isn't enough to make a real difference? The test fails again. Down the waterfall we go. The third level is term extension. Most mortgages are for 30 years, which is 360 months. At this stage, the underwriter has the power to stretch your loan out to a new, 40-year term, or 480 months. Think about it like this. If you spread the same amount of debt over a longer period of time, each individual payment gets smaller. By capitalizing the arrears, dropping the interest rate to the floor, and extending the term to 40 years, they are now pulling multiple levers to reduce that payment. This is a powerful combination, but it comes with a trade-off. You'll be paying for a longer time, and will ultimately pay more in total interest over the life of the loan. But the immediate goal isn't to save you money in the long run. It's to save your home right now. For a huge number of people, this is the step that works. The payment becomes affordable. But if your income has taken a massive hit, or the loan balance is just too high, even this powerful trio of fixes might not be enough. The test fails, and your file tumbles down to the final, most powerful tool in the underwriter's arsenal. This last resort is called principal deferment, sometimes known as principal forbearance. This is where things get really creative. The underwriter takes a large chunk of your principal balance and sets it aside. This deferred amount is still owed, but it's moved into a separate bucket where it accrues zero interest. It effectively becomes a non-interest-bearing balloon payment that you don't have to worry about until the very end of the loan, when you sell the house, refinance, or pay the mortgage off in 40 years. Let's say your new balance after capitalization is $315,000. The underwriter might defer $80,000 of that principal, This means your new monthly payment is now calculated on a much smaller balance of just $235,000. Combined with the rock-bottom interest rate and a 40-year term, this can cause a dramatic, life-changing reduction in your monthly payment. This is the lender's ultimate tool to make a seemingly impossible situation work. So, you see the tools: capitalization, rate reduction, term extension, and principal deferment. But how does the underwriter know when to stop? How do they know what the right payment is? This brings us to the secret formula. It's not really a secret, but it's the number that drives this entire process. It's your debt-to-income ratio, or DTI. Specifically, they are laser-focused on one particular number: your housing ratio, which is your total monthly housing payment, that's principal, interest, taxes, and insurance, or PITI, as a percentage of your gross monthly income before taxes. For most modification programs, the target is 31%. They want your new modified housing payment to be at, or very close to, 31% of your gross monthly income. Let's run the numbers. Say you and your spouse have a combined gross income of $6,000 per month. The underwriter's target for your new mortgage payment is 31% of that number. So, they multiply 6,000 by 0.31. The target payment is $1,860 per month. That is the magic number. The entire waterfall process is a systematic effort to hit that $1,860 target. They'll capitalize, then drop the rate, then extend the term, then defer principal, all in service of getting your PITI payment down to that specific calculated target. This is why your income documentation is so critical. The underwriter isn't just checking to see if you have a job. They are taking your proven documented gross income and plugging it into this exact formula to determine the payment they are trying to build for you. If you overstate your income, the target payment will be too high for you to afford. If you understate it, you may not appear to have enough income to support any payment at all. Okay, so the underwriter has used the waterfall, they've hit the 31% target, and they've crafted a new loan for you that looks affordable on paper. It should be approved, right? Not so fast. There is one final overarching test that the entire proposed modification must pass. It's the ultimate gatekeeper, and it's called the net present value, or NPV test. This is the cold, hard business calculation behind the entire decision. The NPV test is a complex algorithm that asks one simple question: will the investor who owns this loan make more money by giving you this modification, or by foreclosing on you? It's a brutal, unemotional financial showdown. The calculation compares the cash flow the investor expects to receive from your new, modified loan payments over time versus the net amount they expect to recover by taking your house, selling it, and paying all the associated legal and realtor fees. The NPV model crunches dozens of data points: the proposed new payment, the interest rate, the term, the amount of principal being deferred, your home's current market value, the estimated cost of repairs, local property taxes, how long it typically takes to foreclose and sell a home in your specific zip code, and projected real estate agent commissions. If after all that, the calculation shows that modifying the loan is more profitable for the investor, it's called NPV positive. The modification gets the green light. But if the calculation shows that foreclosing and selling the property, even at a discount, would net the investor more money than collecting your reduced payments for years, it's called NPV negative. The modification will be denied. This is the part that feels the most unfair to homeowners, but understanding it is key. Your approval isn't just about whether you can afford the new payment. It's about whether your affordability is also the best financial deal for the investor. This is why, counterintuitively, having a lot of equity in your home can sometimes make getting a modification harder. If you owe $200,000 on a home that's worth $500,000, the NPV calculation might lean towards foreclosure, because the investor sees a clear path to getting all of their money back, and then some through a sale. So the underwriter's job is a delicate dance. They must use the steps of the waterfall to craft a payment that hits the 31% DTI target, and that entire package must then pass the final NPV profitability test. It's a gauntlet of numbers and rules, and once that final test is run, a decision is made. An official letter is generated, an approval, a denial, or sometimes a counteroffer. And what those letters look like, what they mean, and how you should respond to each one, that's precisely what we need to cover next. That envelope feels heavier than it should. You see the return address, it's from your lender, your servicer, and your heart does a little jump, or maybe it sinks. This is it. Weeks, maybe months of gathering documents, making phone calls, and waiting with bated breath have all led to this single piece of paper. This is the moment of truth. Inside this envelope lies one of three paths: one of three futures for your home and your finances: an approval, a denial, or a counteroffer. Each one requires a completely different strategy, a different mindset, and a different set of immediate actions. Let's walk down that first path. You tear it open, your eyes scanning the page, and you see the words you've been dreaming of. Congratulations, you have been approved for a trial period plan. The relief is immense. It's like you've been holding your breath for a month and can finally exhale. You did it. But I need you to pause, take that deep breath, and then switch from relief to scrutiny. Because an approval isn't a finish line. It's the start of a new critical phase. This letter is a contract, and you need to understand every single line before you sign. The first thing you'll see is the trial period plan, or TPP. This is almost universal. Lenders rarely just hand you a permanent modification. They test you first. They'll offer you a trial plan of 3, sometimes 4 months. You have to make these 3 trial payments on time, exactly as specified. No partial payments, no late payments by a single day. Think of it as the final exam. If you pass, the modification becomes permanent. If you fail, you're often right back at square one, and it can be much harder to get a second chance. Now look at the numbers. The letter will detail the proposed modified terms that will become permanent after you complete the trial. This is where you need to be a detective. What is the new monthly payment? Is it what you expected? More importantly, is it genuinely affordable for your budget long-term? Don't let the relief of a lower number cloud your judgment. If your old payment was $3,000 and the new one is $2,500, that's great. But if you can only truly afford $2,000, this solution is just a slower path to the same problem. Next, look at the interest rate. Did they lower it? Is it fixed, or is it a temporary introductory rate that will balloon in a few years? You have to be absolutely sure. Then comes the term. Did they extend the life of your loan? Many modifications achieve a lower payment by stretching your mortgage from 30 years to 40 years. This means you'll be paying for a longer time, and will ultimately pay significantly more in total interest over the life of the loan. It's a trade-off, and you need to be aware that you're making it. But here's the most overlooked and potentially dangerous part of the approval letter: the principal balance. You might see that your new principal balance is actually higher than what you owed before. How is that possible? They've likely taken the past due payments, the late fees, and even the legal fees they've incurred and rolled them into your loan balance. This is called capitalization. On top of that, you need to look for something called a principal deferment, or a non-interest-bearing balance. This is a clever way for lenders to lower your payment without actually forgiving any debt. They take a chunk of your principal, say $50,000, and set it aside. You don't pay interest on it, and you don't make payments on it until the very end of the loan. When you sell the house, refinance, or reach the end of your 40-year term, that entire $50,000 is due in one single balloon payment. It's a ticking time bomb, and you need to know if it's in your agreement. An approval is a victory, but only if the terms of surrender are ones you can live with for the next few decades. Now let's walk down the second path. You open the letter, and it looks like an approval. It uses positive language. But as you read the terms, your stomach twists into a knot. The payment is lower, yes, but they've extended your loan by 15 years and deferred a massive chunk of your principal. This isn't what you asked for. This isn't the solution you need. This, my friend, is a counteroffer. It's the lender saying, "We can't do what you asked for, but here's what we can do based on our internal rules." This happens all the time. Remember the waterfall analysis we talked about? The lender runs your numbers through their pre-programmed system. Maybe you were hoping for a significant interest rate reduction, but the investor guidelines for your specific loan type don't allow the rate to go below a certain floor. So, to get your payment down, the computer's only remaining option was to extend the term to the absolute maximum and defer some principal. The system doesn't care about your preferences. It only cares about hitting a target payment-to-income ratio using the tools it's allowed. When you get a counteroffer, you have a choice. You are not obligated to accept it. Your first step is to do the math, just like with a standard approval. Is this truly a sustainable plan? Or is it a band-aid that postpones the inevitable? Sometimes a counteroffer is still the best option available. But other times it's a terrible deal disguised as help. If the terms are unsustainable, you can reject it. You can call your point of contact and try to negotiate, explaining why the proposed terms don't work. You can ask if there are other programs you might qualify for, but be prepared for them to say no. Their hands are often tied by those investor rules. Rejecting a counteroffer is a risk. It could lead to them simply moving forward with foreclosure. But accepting a bad deal is also a risk. a risk to your financial future. Finally, we come to the third most dreaded path. You open the envelope and the first word you see is denied. It's a punch to the gut. Feels like a final judgment, a door slamming shut. All that work, all that hope for nothing. It is absolutely devastating. But I am telling you right now, this is not the end of the road. In fact, a denial letter is often the beginning of the real fight, because it contains the single most important piece of information you can get. The reason why. By law, the lender has to give you a specific reason for the denial. This is your key. This is your roadmap. The reasons can vary, but they usually fall into a few categories. You might see incomplete application. This is actually good news. It means you simply missed a document, or a page, or a signature. It's the easiest one to fix. You just provide the missing information and ask them to re-review your file. A more common reason is insufficient income. This means that based on their calculations, even with the best possible modification terms they could offer, your income isn't enough to support the new lower payment according to their required debt-to-income ratios. Another one is the opposite, excessive income, which often comes with a note about a negative NPV result. NPV stands for net present value. This is a cold, hard calculation the lender's computer performs. It essentially asks, will our investor make more money by modifying your loan, or by foreclosing on you and selling the house? If the computer determines that foreclosure is the more profitable option, even by a single dollar, it will spit out a denial. Feels personal, but it's just brutal math. Whatever the reason, the denial letter itself is your weapon, because printed right there on that page will be instructions on how to appeal their decision. You have a legal right to an appeal. But here's the critical part. You are on a very strict clock. You typically have only 14 to 30 days from the date on the letter to submit your appeal. Miss that deadline and you lose your chance forever. That appeal is not just a simple letter saying please reconsider. A successful appeal is a strategic, evidence-based argument that directly attacks the lender's reason for denial. It's where you prove their calculations were wrong, provide new information that changes the equation, or present a compelling case for why their decision was flawed. It's your one last shot to turn a hard no into a life-changing yes. And building that perfect, undeniable appeal, well, that is a science and an art form all its own. And the first step in building that appeal is to treat your denial letter not as a tombstone, but as a treasure map. It contains the single most important clue you need, the reason for the denial. Lenders don't just send a letter that says, no. They are legally required to tell you why. Your entire counteroffensive is built on dismantling that specific reason. So let's become detectives. Grab that letter, and let's dissect the most common reasons for denial and how to build a case against each one. The first and most frustratingly common reason is an incomplete application. They'll say you failed to provide a required document. Your first instinct is anger. But I sent that in twice. I hear you. But for the appeal, emotion is your enemy. Evidence is your ally. Your mission is to make it impossible for them to use this excuse again. Your appeal should include a crystal-clear cover letter stating, in response to your denial for an incomplete application, please find the attached specific document name. Then, attach a pristine, legible copy of that document. If you have proof you sent it before, like a fax confirmation or an email, include that too. You are not just resubmitting. You are creating an undeniable record that you have fulfilled their request. You are cornering them with compliance. The second common reason is income not sufficient or failure to meet affordability guidelines. This means that based on the numbers you provided, they calculated that even with a modification, you still can't afford the new lower payment. This is a gut punch, but it's not a knockout. Your appeal here has two potential angles. Angle 1. Their calculation was wrong. Did they fail to include income from a side job? Did they miscalculate your spouse's overtime? Go through their math with a fine-tooth comb. In your appeal letter, you will state, your calculation appears to have omitted my part-time income, as evidenced by the attached pay stubs and bank statements, which average an additional dollar amount per month. You are correcting their work. Angle 2 is more common. Their calculation was right, but your situation has changed since you applied. Did you just get a raise? Did your spouse start a new job? Did a non-contributing tenant move out and you now have a renter who pays on time? This is new evidence. This is the heart of a powerful appeal. You need to provide rock-solid proof of this new income. A letter from your employer confirming the raise. A copy of the new lease agreement. Updated pay stubs. You're not just asking them to reconsider. You're giving them a brand new financial picture that makes their original reason for denial obsolete. Now let's flip the coin. What if the denial reason is excessive income? It sounds crazy, right? You're asking for help because you can't afford your mortgage, and they're saying you make too much money. This usually happens when your gross income looks high on paper, but your actual take-home pay is eaten up by non-discretionary expenses they didn't properly account for. Things like massive student loan payments, court-ordered child support or alimony, or staggering medical bills. Your appeal must be a masterclass in budgeting. You need to provide a detailed household budget that shows every single dollar coming in and, more importantly, where every single dollar is going. You need to provide documentation for these high expenses, the court order for child support, the statements for the medical debt. Your argument is, while my gross income is X, my disposable income after mandatory obligations is only Y, which is insufficient to sustain the current mortgage payment. Your analysis failed to account for these unavoidable costs. But the most complex, the most intimidating reason for denial is the dreaded NPV negative. NPV stands for net present value. In simple terms, this is the lender's cold, hard calculation that they will lose less money by foreclosing on you than they would by giving you a modification. It's brutal, but it's just math. And because it's math, you can challenge the inputs to their equation. The NPV calculation relies on a few key variables: your home's current value, the estimated cost of foreclosure in your state, and the interest rates they expect to get. Your appeal needs to question their numbers. The biggest variable you can challenge is their valuation of your property. Servicers often use a cheap, fast, automated valuation or a quick drive-by broker price opinion. These can be wildly inaccurate. Your weapon here is a more credible valuation. You could hire your own licensed appraiser to conduct a full appraisal. Or, you could ask a local real estate agent for a comparative market analysis, or CMA, showing recent sales of similar homes in your neighborhood that are lower than what the bank is likely using. In your appeal, you present this new evidence and argue, your NPV calculation was based on an inflated property value of X. As the attached appraisal shows, the actual market value is closer to Y. Recalculating the NPV with this accurate figure will demonstrate that a modification is, in fact, the more profitable option for the investor. You are literally rewriting their profit and loss statement for them. So you've identified the reason, you've gathered your evidence. Now you must write the appeal letter itself. This letter must be professional, concise, and surgical. Start by clearly identifying yourself, your loan number, and the fact that you are appealing the denial dated date. In the very next paragraph, address their reason for denial head-on. My application was denied due to insufficient income. Then, immediately present your counter-argument. This letter and the attached documents provide new information regarding a recent salary increase that was not included in my original application. Then, and only then, you can briefly, and I mean briefly, reiterate your hardship in a sentence or two. It reminds them there's a human story here, but it doesn't distract from the core, evidence-based argument. The bulk of the letter is you systematically presenting your new evidence. Use bullet points. Make it easy to read. Attached you will find a letter from my employer dated date, confirming my new salary. My 2 most recent pay stubs reflecting this increase. An updated household budget. Finally, your closing paragraph must have a clear call to action. Given this new information, I respectfully request a re-evaluation of my modification application. I am confident that with this updated financial picture, I will meet your affordability guidelines. I am committed to my home and look forward to your positive reconsideration. Sign it, date it, and send it via a method that gives you a tracking number and delivery confirmation like certified mail. You need proof they received it. Now, what happens if you submit this masterful appeal and they deny you again? Do not give up. It's time to escalate. The person who reviewed your appeal is likely in the same department as the person who issued the first denial. You need to get to a higher authority. Call your servicer and ask to speak to a supervisor or a manager in the loss mitigation department. If they stonewall you, ask for their Office of the President or Executive Customer Service. These are special high-level departments designed to handle escalated complaints. When you speak to them, you're not just a loan number anymore. You're a problem that a lower-level employee couldn't solve, and that gets their attention. If internal escalation fails, it's time to bring in outside forces. Your first and best ally is a HUD-approved housing counselor. Let me repeat that, HUD-approved. They are trained professionals, their services are almost always free, and they are not scammers. They can advocate on your behalf, They know the right language to use, and a request coming from them often carries more weight with the servicer. If your case is complex, or if you believe the servicer has violated your rights, for example, by moving forward with foreclosure while your modification review is ongoing, a practice known as dual tracking, it may be time to consult with a qualified attorney specializing in foreclosure defense. This costs money, but an attorney can wield legal authority that you simply don't have. And finally, there is the nuclear option: filing a formal complaint with the Consumer Financial Protection Bureau, the CFPB. This is a federal government agency. When you file a complaint online, it creates a formal case. The CFPB forwards that complaint to your mortgage servicer, and the servicer is legally required to investigate and provide a detailed, written response to you and the CFPB, usually within 15 days. This forces them to create a paper trail and have a senior-level employee review your entire file. It shines a very bright, very public spotlight on your case, and sometimes, that spotlight is all it takes to get a long-overdue approval. The appeal process is a testament to persistence. It's about refusing to take no for an answer, and instead using that no as the blueprint for your eventual yes. And when that yes finally comes, it will most likely arrive in the form of a trial period plan, the critical next step on your path to a permanent solution. The trial period plan, or TPP. For many homeowners, these 4 words feel like the finish line. The letter arrives in the mail, you tear it open, and you see an offer for 3 months of reduced payments. The relief is overwhelming. You feel like you can finally breathe after months, maybe even years of holding your breath. You've done it. You've climbed the mountain. But I'm here to tell you, with all the seriousness I can muster, that this is not the summit. This is the final treacherous ridge just before it, where the winds are strongest and one wrong step can send you tumbling all the way back to the bottom. This is the most dangerous phase of the entire modification process, precisely because it feels like the safest. Let's be crystal clear about what a trial period plan is. It is a test. It is an audition. The servicer is essentially saying, "All right, you've convinced us on paper that you can afford a new payment. Now prove it." They will typically offer you 3 consecutive monthly payments at an amount that is an estimate of what your final modified payment will be. I need you to burn that word into your memory: estimate. It is not a promise. It is not a contract for a permanent modification. It is a temporary agreement that, if you successfully complete it, may lead to a permanent offer. The entire purpose of the TPP, from the servicer's perspective, is to see if you will fail. They are stress testing your financial discipline, and if you make a single mistake, they will not hesitate to pull the offer and restart the foreclosure clock. So, how do you navigate this minefield and turn that trial offer into a permanent solution? You do it by adhering without deviation to 3 golden rules. These aren't just suggestions. They are your lifeline for the next 90 days. Golden rule number 1. Pay on time every time, to the exact penny. This sounds obvious, but you would be shocked at how many people stumble on this first, most critical step. When they say the payment is due on the 1st of the month, they don't mean the 2nd or the 5th, or whenever your paycheck clears. They mean the 1st. If your trial payment is $1,254.38, you do not pay $1,255 to round it up. You do not pay $1,254 because you're short a few cents. You pay the exact amount down to the penny. Why the fanaticism? Because servicers' computer systems are often automated to look for perfect matches. An overpayment can get flagged and put into a suspense account, technically counting as a non-payment. An underpayment, even by a single cent, is an incomplete payment. Either scenario can be used as grounds for disqualification. They gave you the terms. Your only job is to meet them perfectly. Now let's talk about how you pay. This is critical. Do not, under any circumstances, just rely on your bank's online bill pay. Don't assume a check you mail will get there on time. For these 3 months, you must become obsessed with proof of payment. The safest method is to use a certified check or a money order sent via a trackable delivery service like FedEx, UPS, or USPS certified mail with a return receipt. Yes, it costs a few extra dollars, but that tracking number and signature confirmation is your ironclad proof that you held up your end of the bargain. If you absolutely must pay online through the servicer's portal, take a screenshot of the payment confirmation page. Save the confirmation email. Download the PDF receipt. Create a folder on your computer and name it TPP Proof. You need a bulletproof paper trail, because if they come back and say, "We never got your payment," your word against theirs is a losing battle. Proof is your only weapon. 1 day late, 1 penny short, 1 payment lost in the mail without tracking. That's all it takes to fail the test. Golden rule number 2. Read every single word of the trial period plan agreement before you do anything. Don't just scan for the payment amount and the due date. This document is a preview of your financial future. You need to read it like a detective searching for clues. What does it say happens after the 3 months are over? Does it specify the interest rate of the potential permanent modification? Will it be fixed or could it be an adjustable rate that will skyrocket in a few years? Does it mention how they will handle your past due balance, the arrears? Will it be deferred to the end of the loan as a non-interest-bearing balloon payment, or will it be capitalized, meaning it's added back into your principal balance, and you'll be paying interest on it for the life of the loan? These details are everything. You are looking for the shape of the final deal. If you see terms in the trial plan that are unacceptable, like a variable interest rate that you know you can't handle long-term, you need to address it now, not after you've made 3 payments. Call your single point of contact or your housing counselor and ask for clarification. Get it in writing. Remember, accepting and paying the TPP is your tacit agreement to its framework. You are signaling that you find these general terms acceptable. Don't walk into a trap with your eyes wide open. Read the fine print. Then read it again. Golden rule number 3. Maintain communication but do it on your terms. This is a delicate balance. During the 3-month trial period, you may enter a strange communication vacuum. The frantic calls and threatening letters might stop. It can feel peaceful, but it can also be unnerving. Don't just sit back and hope for the best. You need to be proactive. About a week after you send each payment, call your servicer. Don't ask, "Did you get my payment?" Ask, "Can you confirm that my trial payment for month was received on date and has been properly applied to my account for the trial period plan?" Use specific, deliberate language. Get the name of the person you spoke to, the date, and the time of the call. Write it all down in a log. At the same time, you must prepare for confusion. It is incredibly common for a servicer's automated systems to continue sending out conflicting information during a TPP. You might make your first trial payment on June 1st, and on June 15th, you get a scary letter from the foreclosure department saying you are in default and your home is at risk. This is terrifying and it's designed to be. But it's often just a case of one department not talking to the other. This is where your diligence pays off. You don't panic. You call your single point of contact, you calmly state that you are in an active, approved trial period plan, and you reference the payment you made and the confirmation you received. You ask them to confirm the foreclosure activity is on hold, and to make a note in your file. You stay in control of the narrative because you have the facts, you have the proof, and you have the records of your communication. Successfully navigating these 3 months is a full-time job. It requires a level of organization and vigilance that feels exhausting, especially after the long fight you've already been through. But this is the final push. Every payment made on time, every document read thoroughly, every call logged, is a brick you are laying in the foundation of your family's future in that home. You are proving beyond any doubt that you are not a risk. You are a reliable partner. And when you make that 3rd and final payment, you will have done it. You will have passed the test. You have held up your end of the bargain completely and perfectly. And that is when you can expect to receive the final, permanent loan modification agreement. But signing that document is the true finish line. And it comes with its own set of rules and potential pitfalls that can determine the next 30 years of your life. That final agreement is the prize you've been fighting for. And in our final part, we're going to make sure you claim it correctly. Claiming it correctly means treating the documents that land on your doorstep not as a finish line, but as the final, most important exam of this entire process. You've climbed the mountain, but the peak is treacherous, and one misstep here can send you tumbling all the way back down. The first document you'll likely receive isn't the final agreement at all. It's the trial period plan, or TPP. And this is where so many desperate homeowners make a critical mistake. They see the lower payment, they feel the relief, and they think, "I did it. It's over." It is not over. Think of the trial period plan as the lender's final test. They're saying, "Okay, we've looked at your numbers. We've run the calculations. We think you can handle this new payment. Now prove it." Typically, they'll ask you to make 3 or 4 consecutive payments at the new proposed amount. These payments must be perfect. Not a day late. Not a penny short. If the payment is $1,521.48, you pay exactly that. Not 47 cents. Not 49 cents. You must be flawless. During this period, you are under a microscope. Any failure to comply gives the lender the perfect excuse to deny your final modification and restart foreclosure proceedings. This time with a clear record that you failed to meet the terms of their offer. And here's the most dangerous part of the TPP. It is not a legally binding contract for the lender to give you a permanent modification. Read the fine print. It almost always contains language stating that successful completion of the trial plan does not guarantee a permanent offer. It's a one-way street. You are bound to make the payments perfectly, but they are not yet bound to give you the final deal. It is a gut-wrenching, high-stakes audition for your own home. So, you make those payments. You send them via certified mail or get a clear digital receipt. You call to confirm they were received and applied correctly. You leave nothing to chance. After you successfully navigate the trial period, the real prize arrives. The Permanent Loan Modification Agreement. This is the peace treaty. It's a thick packet of legal documents that will dictate your financial life for decades. Do not get so excited that you just sign it and send it back. You must read every single word. Get a cup of coffee, sit down at your kitchen table, and become a forensic accountant for a few hours. Here is your checklist. These are the non-negotiable items you must verify. First, the unpaid principal balance. This is your new starting line. Look at this number very, very carefully. Is it what you expected? It will almost certainly be higher than your last regular statement, because the lender has likely performed what's called capitalization. This is a fancy word for them taking everything you were behind on. The missed mortgage payments, the accrued interest, the late fees, any escrow shortages, and rolling it all into your new loan balance. So if you owed $300,000 and were $20,000 behind, your new principal balance might be $320,000. This is standard practice, but you need to verify their math. Ask for an itemized breakdown of the capitalized amount to ensure they haven't padded it with junk fees or errors. You are paying interest on this new larger balance for the life of the loan, so that number better be right. Second, the interest rate. This is the engine of your new loan. Is the rate fixed? I will say it again, is the rate fixed? Many predatory modifications in the past offered a tantalizingly low teaser rate for the first few years, which then exploded, putting the homeowner right back in the same crisis. You need a fixed rate that is locked in for the entire remaining term of the loan. If you see the letters ARM for adjustable rate mortgage, you stop and you question it immediately. The goal here is stability. A fixed rate is stability. Third, the loan term. Look for the new maturity date. To get your payment down, the lender has likely extended the life of your loan. If you had 22 years left on a 30-year mortgage, they might have reset the clock, stretching the new larger balance back out over 30 or even 40 years. A 40-year mortgage term is becoming more common in modifications. Understand the trade-off here. Yes, the longer term dramatically lowers your monthly payment, which is the immediate goal. But it also means you will be paying tens, or even hundreds of thousands of dollars more in total interest over the life of the loan. It's a bitter pill to swallow, but it's often the only way to make the numbers work and save the home. You just need to go in with your eyes open. Fourth, and this is the one that trips up so many people, the monthly payment breakdown. Your new payment is probably quoted as PITI. Principal, interest, taxes, and insurance. The T and the I are critical. They refer to the escrow portion of your payment, where the lender collects money each month to pay your property taxes and homeowners insurance on your behalf. You must confirm that your new payment includes this escrow amount. Sometimes, a modification offer will only state the principal and interest payment to make the number look lower and more attractive. A homeowner might think, "Wow, my new payment is only $1,300. They sign the papers and 6 months later they get a $5,000 property tax bill from the county they have no way to pay, followed by a notice that their homeowner's insurance has been canceled. This is a fast track back to foreclosure. Your payment must be the full PITI. Verify it. Ask them, does this payment cover my property taxes and homeowner's insurance? Get the answer in writing. Fifth, read the fine print for a waiver of claims. This is a big one. Nearly every modification agreement includes a clause where, in exchange for the new loan terms, you agree to waive any and all legal claims you might have had against the lender for anything they did in the past. If they made servicing errors, charged you improper fees, or engaged in deceptive practices during the foreclosure process, signing this document means you forgive it all. You give up your right to sue them. This is the lender's get-out-of-jail-free card. For most people, the benefit of a stable, affordable mortgage outweighs the ability to pursue a potential lawsuit, but you need to understand that you are signing away your legal rights. Once you have reviewed every line item, and the numbers match what you were promised, it's time to sign. The lender will require the signature to be notarized. This means you have to sign the document in the presence of a notary public, who will verify your identity and witness your signature. This formalizes the agreement and makes it legally binding. Do not rush this. Bring your ID, read the document one last time in front of the notary, and then sign it. Make a complete copy for your records before you send the original back. Send it via a trackable delivery service like FedEx or UPS, so you have absolute proof of when it was sent and when it was received. Your work is still not done. After the lender receives and countersigns the agreement, they have to officially record it with your county. This can take weeks or even months. During this time, you must continue to make your trial payments on time. Do not assume the deal is done until you receive official confirmation from the lender that the permanent modification is active. Your first permanent mortgage statement is the final piece of evidence. When it arrives, check it against the agreement. Does the principal balance match? Does the interest rate match? Does the monthly payment match? If everything lines up, take a deep breath. You did it. But what if the final offer is bad? What if the payment is still too high? Or the terms are predatory? You have the right to say no. You are not obligated to accept a bad deal that will only set you up for failure. You can reject the offer and try to appeal, providing new information or pointing out a miscalculation. You can re-engage with them to see if there's any other possibility. It's disheartening, but accepting a bad modification is worse than having no modification at all. And now, for the most important part, life after the modification. Getting that final approval is not the end of your financial recovery. It is the beginning. You have been given a second chance. You have a stable, predictable housing payment you can afford. The first thing you must do is rebuild your budget around this new reality. The constant stress and uncertainty are gone. You can now plan for the future instead of just surviving the present. Your credit will have taken a major hit through this process, but a successful modification is the first giant step to rebuilding it. Every on-time payment you make from here on out will begin to slowly heal that damage. After a year or two of perfect payments, you will see your credit score begin to climb again. This entire journey from that first missed payment to the final signed agreement is one of the most stressful experiences a person can endure. It tests your patience, your resilience, and your spirit. But you have navigated the maze of paperwork, the endless phone calls, and the soul-crushing uncertainty. You fought for your home, not as a victim of circumstance, but as an advocate for your own family and your future. The system is complex and at times it feels designed to make you fail. But we've walked through it together, from understanding your options to gathering your documents, from negotiating with the bank to scrutinizing that final contract. The goal of this series was to pull back the curtain and give you the playbook, to arm you with the knowledge and the confidence to fight back. Share this information. If you know one person, a friend, a family member, a coworker, who is hiding in fear of their mortgage, send them this series. You could be handing them the lifeline they need. You secured your home. You weathered the storm. That house is more than just a collection of wood and nails. It's your foundation. It's where your life happens. Now you get to build on it.